You know what they call a market correction? It's called the day after you buy stocks. You know, it has been a rough market, right? If you've been investing in VOO, the S&P 500 index fund in January 2022, you're probably not real happy right now. But value hasn't been so bad. So my solution today for us is to maybe look for something that offers value and dividends, and maybe some growth potential, right? So I'm going to call these dividend ETFs. That's Dividend ETF Day. So we're going to take a look at a couple of these and maybe see if these might be right for our portfolio. If that is what you're looking for, please stick around. Whoop. All right, so who loves dividends out there? I know I like my dividends. However, I would not say that I go shopping for dividends. It's one of the rules that I stick to that I have learned a long time ago, is that when you go to research a stock or you go research an ETF, you don't first look over and go, oh, look, it pays a dividend. You do all your other research because that's where you're putting your money. You're putting your money into something that you want to grow. So if the first thing you do is go, oh, it pays a 6% dividend, I'm going to buy it. Well, that's the wrong way to go about it. So we don't want to go yield shopping, right? What we want to do is find the best place to put our money. So the very first thing we want to do is go investigate and see exactly what's in this thing. We want to decide then if we want to add it to our portfolio. Then we have a little kicker off the side. We go, oh, and it pays a dividend. That's the way we're going to go about this when we look at these things. So we're going to be talking about dividend ETFs, but in the back of your mind, I want you to be thinking, you know, I can always create my own dividend, right? I can sell one share next week and look, I got a dividend. So we want the thing that's going to grow our money the most. If you're new to investing, what is an ETF? Well, it's simply a basket of stocks, a bunch of different stocks we pull together that tracks an index. So they give us the rules of what we're going to do and how we determine what's going to be in this. So when I look for these, what am I looking for? I'm looking for a low expense ratio, which is typical of ETFs, but we'll point that out as we go along. We'll also want to know how they determine what will be in this, right? Those are the rules. And then I want to look at the main holdings and the weights of what's in there. See if I agree with what's in there. Because in certain situations, I like to invest in things that I really know about. But if I don't really know about them, I think ETFs are a great vehicle to invest in a particular sector or an area of the market. Then I look at historical returns because I want to see if historically it's performed well, because then I can hope that it does that in the future, but we don't really know. Then I look at dividend yield and dividend growth. And because this isn't a video about, you know, dividend ETFs, I imagine that's something that you're really interested in. So we'll take a good look at those as well. Finally, I don't promote a lot on this channel, but one thing that I really love is M1 Finance. And I have a link down in the description. If you sign up for an account, you get some free money, which all sounds great. But the reason I love it for these types of products is if you invest in VOO, that S&P 500 index, and one of these dividend, right, ETFs, and like you'll see when we see it, sometimes one outperforms the other. Well, when it receives that dividend, it's going to rebalance your portfolio automatically. It's going to put it back into the piece of pie that needs it. So like VOO is not performing really well. It's down. That's where I'd want the money to go. But in some of my other accounts, it doesn't work that way. But with M1, it picks it for me. It rebalances automatically. So that's a great feature for this type of thing and this type of account if you're looking for a lot of dividends and you want to reinvest them. So with all that said, let's get started. Let's take a look at these. All right, so the first one I want to talk about is SCHD, and this is a really popular dividend ETF and one that I like a lot. A couple of the highlights here is it only includes firms with a 10-year history of paying dividends. So it looks for sustainable dividends, right? And it does not include REITs, which, you know, that's one, do you want it to or do you not want it to? But this one does not include REITs. And securities are capped at 4% and sectors at 25%. So it has nice controls in place. And it reminds me a lot of another one that I like, which is VYM from Vanguard. I own a lot of VYM and I own some SCHD, and they're both really good. But when I posted about VYM, everybody said, look at SCHD. And I do like the controls that they have in place. So if we look over here at the performance over the last 52 weeks, we're going to see it's returned over 22%. Outstanding. Great job. And with a net expense ratio of only 0.06%, which means if you put $10,000 into this, it's only going to cost you $6 per year. That's pretty darn good as well. About as low as you're going to find. Now, if we look at the chart, you can see it's had kind of the same response. It's come off a little bit over January. You know, it hasn't performed real well, but compared to like VOO, the S&P 500 index fund, it's outperformed. And we'll take a look at that here in a minute. The top sector, though, is financials, and I like financials going forward, so that looks pretty good. And the 1, 3, 5, 10-year returns are pretty good. So let's keep in mind that 5-year return of a little over 16%, because that's pretty darn good. And if we look up here at the 30-day SEC yield, we're going to see 2.93%. And if we look at the distribution yield over the last 12 months, right, about 2.78%. So just a little bit under that 3% that I would like to see, but it's not all about the dividends. Again, we want to also know what all is in here. But remember that 16%? If we look at that compared to VOO and we go out to 5 years, it's not too far off, right? This is a total return. And for VOO, it's been about 18.4%. So VOO, which pays a lot less in dividends, but has had a nice return over the last 5 years. So keep that in mind. Now let's start taking a look at what is actually in this one. If we look at the top 10 holdings, it's going to be a lot of the names that you're probably quite familiar with, like Pfizer, like Broadcom, like Cisco, Coke, Pepsi, whichever one you prefer, IBM, and Home Depot. So it's all in there, and that makes up 40.88% in just those 10. Altogether, there's only 105 holdings altogether, and the exposure here is broadly North America, right? So we'll talk about another one that later that will expose you to Europe and other parts of the world, but this is in North America. And if you look at the fund characteristics down here, you're going to see price to earnings and price to book. So you can't dig out a whole lot there except to say that with price to book of 3.82, price to sales of 2.35, there's a lot of good in here. There might be some that you don't like overall, but pretty good fund overall. Now, another really important part of these types of ETFs is dividend growth history. You kind of see what it's done in the past and what we can maybe expect in the future. And we don't know that. I realize that. But past performance on this particular one, SCHD, you can kind of see it's been consistently growing. That payout amount has consistently grown. And that's one of the things I like most about SCHD is this past performance, growing that dividend. So if you got in a long time ago and you saw that dividend growth, you'd probably be pretty excited right now. So if we can carry that forward, great. But that nice dividend growth over the last 5 years, that gets me pretty excited. So overall, probably out of all this whole group, if I was going to buy one and one only, I'd probably look at SCHD. So one thing that I did with all four of these is I compared it to VOO, and I pulled it up here in chart form so you can kind of see for yourself how it's performed versus VOO. So this line on the bottom is VOO, the line on the top is SCHD. So you can see over the last month, it really has outperformed VOO, which is a broad-based ETF that will have lots of tech stocks in there that have really gotten beaten up. So depending on the market, you might see a different performance, right? So that's over the last month. But if we start zooming out, go to 1 year, we'll see, wow, it's still outperformed VOO over the last year. There's been times they've kind of crossed back and forth, but it's really held its own over the last year. Then if we finally go out to that 5-year point, remember those returns before, you'll see that it's still not too far off, but in general, VOO has outperformed it. So we'll see where we go forward. It'll be interesting maybe to look at again out in 3 or 6 months from now to see how it has performed compared to the broad-based market ETF like VOO. So the next one I want to talk about today is SPYD. And again, this one focuses on US large cap, but not as many controls in place. So all it does is it ranks all dividend payers in the S&P 500 by yield and selects the top 80. It does include REITs as well. So you're going to find things in their top 10 holdings such as Simon Property Group. So you have to decide, is that something that you want exposure to? But if we just look at the 52-week performance, wow, 26%. It had quite the year. And that net expense ratio is, instead of $6, it's $7. Can you swing that extra buck on your $10,000 investment, for example? Probably so. I bet you can. So now if we look at the chart, it's had a pretty darn good year like we just talked about. And its top sector is utilities, which is 18% of the fund. 1 year, 3 year, 5 year performance. Wow. Now this is where it really starts to change, right? So you look at that 1 year performance, 3 years, and then it really drops off after 5 years. So we want to find out exactly what's going on there and decide, is that something we want to include in our portfolio just for the dividend? Now the dividend is pretty darn nice. 3.84% over the 30-day SEC yield, and annually over the last 12 months, 3.68%. So it is a high yielding ETF, but you have to decide, are you willing to give up maybe some of that long-term performance for that money in your pocket right now? Now, if we jump over and we look at the holdings here, you're going to find Pfizer, Broadcom, sound a little bit familiar, right? There's that Simon Property Group in there. You're going to find Marathon Oil, Key Corp. So you're going to get some banks and financials in here as well. Again, focused on North America, right? And if we look down here at the fund characteristics, you can now start comparing, right? Fund characteristics from one to the other. So you're going to find that that price to earnings looks at 17. Price to books dropped off down to 1.96. Price to sales down to 1.4. So there's probably a little bit more value in here, but less performance over the long term. So we have to decide, is that something that we like or that we don't like? Now, if we happen to come over here and we pull up the last 5 years of history of dividend growth, we're going to see, wow, it's a little bit more erratic. We've seen ups and downs over the years. We see years where it's paid out, over $1.70, and years where we're down, like 2021, about $1.55. So a big difference. More ups and downs. That dividend yield, might not be able to count on it as much. And it definitely doesn't look like you can count on the growth as much as something like SCHD. And for me, this is where it really gets interesting with SPYD, because if you look over the last 30 days, you're going to see that this has outperformed the S&P 500 by about 9%, right? This blue line on the top, it's almost returned 2%. While everything else was falling apart in the world, all the value in there has done quite well, returning 2%, or VOO is giving up over 7%, like a 9% swing there. Pretty significant. Let's zoom out though a little bit and kind of see what happened over the last year. Take a look at the year chart, and well, it's actually held up pretty well, right? It's done pretty well. It's returned more than VOO after this recent pullback. So you can kind of see what kind of market we're in and how this might be able to balance out your portfolio a little bit with some of it in there. But then we got to zoom all the way out to 5 years, and you can see how VOO's just kind of pounded it in the sand over a 5-year period. So it might be something that you look to add, especially if you want to skip a little bit off the top, if you're really interested in that dividend, if that's really important to you. But otherwise, look, VOO is going to outperform it in the long run, at least based on past history over the last 5 years. We'll see how much this pulls back. Let's look in 6 months out, and let's see what this chart looks like. But overall, it might be just one of those opportunistic times when you look to add it in certain markets. The next one I want to look at is HDV from iShares. Now, this one tracks a dividend-weighted index, screened for high earnings potential and dividend sustainability. Now I'm excited. All right, so eligible securities for this one must pass 2 Morningstar proprietary screens, and there are no REITs in this particular one. But if we bounce over and we start looking at the performance over the last 52 weeks, you're going to see another one that's had a pretty good last year, right? 18.7%. Net expense ratio is quite low, 0.08%. So you owe me another $1. Now we're up to $8 per $10,000 invested. If we pop over and look at the chart again, it's a similar chart to what we've seen with some of these other ones too. But again, a strong January overall. It's really bounced back up there. Now their top sector is healthcare. All right. And if we look at the 1 and 3 and 5 years, we're going to look at 19%, 10%, drops down to 8% as we zoom out to that 5-year period. But over 10 years, about a 10% return. So not too shabby. Now, what people like on these, right, is that distribution yield in the SEC yield, which is 30.86% and 3.47% over the last year. So if you want to put a lot of money in your pockets, this might be a good option for taking some of that money off. But yeah, it's done pretty well as far as how much it's putting in your pocket through distributions. Now, if we look at actually what's in this, then if we want to look at the top 10 holdings, you're going to see all the ones you probably think about when you start thinking about dividends, like ExxonMobil, Johnson & Johnson, and Verizon, CVX, AbbVie, Pfizer, Procter & Gamble, Cigarette People, Coca-Cola, and Cisco. And those top 10 altogether make up 53% of this, with 81 holdings altogether. So that's what you're going to find in this. All these high dividend yield ones, all in the North America pretty much. And the fund characteristics is definitely not the value that we saw with SPYD, but it still looks pretty strong. Again, we're focused on maybe a little bit different, some different sectors and things like that might not offer the value, might trade a little bit over more of a rich multiple. And if we look at that dividend growth history, you're going to see that it looks better than that SPYD did, but it did have a little bit of it had a huge up year in 2020 where it really grew over 11%. And then in 2021, it dropped off just slightly, but it's been let's call it a slow grower. Okay, fine. And if we look at those charts and we want to compare this again to VOO and kind of see how it's doing versus the broad market, you're going to see that it's done really well over the last 30 days, right? It's returned 2%, whereas VOO has dropped 7%. So again, over a 9% swing over the last 30 days. Pretty darn incredible, actually, when you think about it. And that's one of the reasons you might, again, add something like this to your portfolio. Skim a little off the top and have good performance at times. Now, if we start to zoom out, you see what I'm talking about. last year with that big drawback, even with that big pullback in VOO, they're pretty much a match over the last 52 weeks. Again, if we pull out to a 5-year chart, you're going to see this is where VOO really shines, with the broad market in general, with all those great tech stocks in there that have carried it higher. Again, now we'll see what it looks like in 3 or 6 months from now. But right now, it's really on pace to just continue to pull away over time, is what it looks like, right? So you are going to have that sacrifice if you want to skim some of that off the top and put some of that in your pocket. So overall, not a bad option if you're looking for a little bit of that extra income. The last one I want to talk about is VYMI, and this one's quite different compared to the others. But what it does do is it exposes you to international stocks. And I think with the market that we're in right now, it's something you might think about doing. So you heard me talk about VYM from Vanguard earlier. It's one of my favorites. Yeah, the I, you get the international flavor here. So VYMI tracks a market cap weighted index of developed and emerging markets that pay above average dividends. So this thing's going to get a little wild compared to the others. There are no REITs in this one, but you get exposure to high yield international stocks. Altogether, 4.25% yield. So this is the highest yielding of all the ones that we've talked about thus far. If we look at the 52-week price performance, it's not where the other ones have been, right? We're including the whole world. How is it performing right now? Well, 8.75% over the last 52 weeks as of January 28th, and with a net expense ratio of 0.28, so $28 per 10,000, the most expensive one we talked about, but still not wild, not too bad. But if we zoom up here, you're going to see it's financials, 31%. That's the top sector. And 1, 3, 5 years, you're going to see a 15% over last year as of the end of 12/31. That's why it's so much different, because January was not kind to this one. You can see that in the chart. But the 3-year return of 10% and a 5-year return of a little under 8%, 7.65%. So very different, right? But let's see what we get exposure to here when we talk about this one. So as we said, the yield is included up here, but 4.25%, so the highest yielding one that we've talked about. And if we take a look at their top 10 holdings, you've probably recognized a lot of these, but some of them you may never have heard of, right? I'm sure Nestle, you've eaten those before. Toyota, you've driven one before. AstraZeneca. What else do we have up here? We have Unilever and Royal Bank of Canada. Actually, I own shares of Royal Bank of Canada. It's been a good performing stock. I like that bank. If you like Canada, maybe pick up some shares of that as well. But at regional exposure wise, now we're opening ourselves up to Europe and Asia, and still some North America, Middle East, and so forth and so on. So we're going all around the world. Altogether, 1,237 holdings, where the others were right around 80 to 110 or so. 1,237 holdings, so much more broad in this one. And if you look at the fund characteristics, it looks like a value stock. Price to earnings of 10.94. Price to book of 1.28, price to sales of 1.09. That's a value stock, all rolled into an international ETF. So how do you feel about something like VYMI as maybe being a small portion of your portfolio? Well, let's take a look at performance. And also, we got to look at the dividend growth history. Because again, you have all these different stocks all around the world, different economies performing differently, and you're going to get erratic dividend growth, right? Up 1 year, down 1 year, all over the place. So you're not going to be able to count necessarily on 4.25%. It is going to bounce around, so something to consider. And then if we go and we start comparing it to the S&P 500 Index Fund, VOO, you're going to see over the last 30 days, it's done quite well, as VOO was getting hammered. As we zoom out, though, we're going to see VOO breaks away. Even over the last 52 weeks, it's outperformed it, and it's kind of just stumbling along. So it really depends on what you want as far as exposure to the rest of the world. I think it is an important component, though, and something you should consider. And then as we zoom out to 5 years, again, you're going to see that the broad market has outperformed with all those great tech stocks. Even though it's come off a little bit, it's still well outperformed this particular ETF. With VYMI, some of your dividends will not be qualified, so you will be paying at a higher tax rate. So that's something to consider by your own personal situation. You can do some research there and find out what portion of those are not qualified. But because it's an international fund, you're going to have some of that. Now, if you have any questions on any of this at all, please ask down below. If you like this type of content, please like and subscribe. Really appreciate you watching. Have a great night. Take care. Woo!